So welcome everybody to this SCOR annual lecture. Let me remind you it's organized in the context of the Chair SCOR, the joint partnership between SCOR, which is the main French reinsurance company, and the Paris School of Economics. And this chair is devoted to a hot topic, broad and hot, which is macroeconomic risk, because if you are a reinsurance company, not an insurance company, but the reinsurance company, macroeconomic risk, of course, is very important to you. So we are very grateful to SCOR for this partnership, and in particular for sponsoring this annual lecture. And this year we are very happy to have Nick Bloom from Stanford, who already came, and who already not came since this lecture was scheduled in March, and your plane was cancelled for some exogenous reason. Today we have a strike for more like endogenous reasons, but this strike is no impediment to the SCOR annual lecture. On the contrary, the streets are empty, so it was very easy for you to come from the airport. So Nick Bloom is the author on risk and uncertainty and macroeconomics. He has established himself as the leader is the William Eberly Professor of Economics at Stanford. And then, you know, the credentials are so long that I cannot detail them all. But you have in particular received a number of prestigious prizes. You are a fellow of the American Academy of Arts and Science. You got the Frisch Medal, the Kaufman Medal, and the National Science Foundation Career Award, and plenty of other achievements. I also noted that you have a website on real-time measurement of economic policy uncertainty. So there is a graph for economic policy uncertainty in various regions of the world. And if you connect there, you will see that the outlook in the last years is not so good. I mean, it's not improving. There is more uncertainty rather than less uncertainty, and perhaps you are going to tell us more about these issues.
Okay.
So, thank you very much.
So
you will. So I suggest, you know, that you speak for 1 hour and 15 minutes, and then we will have open discussion.
Great, just thanks very much. I'm also happy to take. If it doesn't throw things off, I'm happy to take questions during, if that's okay. Sure. I haven't precisely timed. So I was first saying it's like really nice to be here. I think the first time I came out to PSE was before the building existed. Was Eric Moran invited me out maybe 10 years ago. I remember there was like a vast construction works going on. And actually I was watching the video, so it's really nice to finally get in. I wandered around, you know, it's fantastic to finally to be here. So why don't I just start this off? Here we go. So I know there's been a lot of work at PSE on growth and inequality. I wanted to link to growth from a different angle, which is actually uncertainty. So recently there's been a huge surge of concerns that uncertainty slowing growth down. So given this is a public lecture, I'm going to make this slightly more accessible and broader. But for example, if you go to the FT, if you don't like the FT, the Wall Street Journal, similar type of thing, trade uncertainty slowing down growth. The Economists, similar thing. These are all from the last couple of months. The IMF from the BBC News reports that global growth is going to be the slowest since the financial crisis. And if you look at what they blame it on, they blame it primarily on trade uncertainty, and in fact, Brexit uncertainty. And then, close to home. If you can't tell from now, I'm British. Hopefully you didn't think I was Australian. It happens. Or anywhere more exotic than that. Definitely not American. So uncertainty's been a big issue. As mentioned, I actually got into working on uncertainty when I was a graduate student in the mid-90s. I was doing my PhD, and I read the book by Dixit and Pindyck, which I don't know how many of you have read it. Back then, it was like a really big thing in the 90s. In fact, such a big thing, it was like in airport bookstores, which is very odd because it's full of maths. I'm not sure how many people, I think it was like Thomas Piketty's book, how many people bought it and actually read it. But Dixit and Pindyck It was a very influential book in the 90s, and so I got into it, got into the empirical side of it. And in the mid-2000s, I remember sitting down with Steve Davis in the NBR, actually, probably about 2008 or 9, to think about how to measure policy uncertainty, economic policy uncertainty, motivated by the financial crisis and Congress's push for TARP and banking reforms, and this was generating at the time a lot of policy uncertainty. So we set up, we now have a paper, and as mentioned, there's a website trying to measure policy uncertainty. I wouldn't say, I don't want to claim this is a perfect measure. What we basically do is use newspapers. So we started in the US, we now have measures across a number of countries, and here's what's called the global measure. So in each country, to try and measure policy uncertainty, we go to the leading newspapers. So for example, in the US, we take like the Wall Street Journal, the New York Times, Boston Globe, LA Times, etc., the 10 leading newspapers, and look for the frequency of articles that talk about the economy, that talk about, mention the word uncertainty, and talk about key policies. And just use that as a share of articles, and that generates a measure for each country. Here's the GDP-weighted measure for the entire world. You can see that policy uncertainty, we set it up as an average of 100 going back to 1985. It's kind of average. It rises a bit in the global financial crisis, but it just really surged recently. And Trump and Brexit are part of the factors. There's also a lot of policy uncertainty right now in China. So the trade tariffs have generated issues in the US. If you look at the Chinese press, it's like full of them because China's much more affected actually than US is. So seems very worrying, and this if you want the data, it's on the website, but this kind of data has been one of the things driving concerns over slowing growth. So maybe it's all media hyperbole. You should remember this is all based on newspapers to explain, if you're a Trump, I'm definitely not a Trump supporter. If you were a Trump supporter, you might be blaming it on mainstream media. It is true the media seems to present stuff very differently. So yesterday, in preparation for today, I wondered how the different media outlets would be talking about impeachment. So here's CNBC, which is seen as kind of left of center, and reports the impeachment and the Democratic leadership race with them smiling. It's kind of relatively pro-Democrat, anti-Trump on the impeachment. You go to Fox, the other extreme. It's all about how the people in the impeachment, the Democrats are idiots, legal and voted geniuses, Democrats blasted, just very, very different take on things. So we may be nervous about using media. So in another project I've been doing with the IMF, we use something we think is non-politicized, which is the Economist Intelligence Unit quarterly reports. So I don't know if people have used these, but the EIU, the Economist newspaper, once a month, but primarily quarterly, generates reports that discuss each country. So I put up here for France, and this is for end of 2007. They're kind of 30 pages on average, or 29, mean and median are both 29-page reports with a pretty standardized format. And what we've done for that is just search for the frequency of the word uncertainty. So here's uncertainty about Sarkozy's policy. Here's uncertainty about, in fact, about the US, because that's going to affect France. And here's uncertainty about global financial markets. So we use that as another measure of uncertainty. If you aggregate that as a completely different measure of uncertainty based on instead the Economist Intelligence Unit, this also shows an upward trend. So based on the EIU index, you again see that apparently now are a period of pretty high uncertainty. So both newspaper measures and EIU measures show rising uncertainty. Why am I showing you this? The reason it's actually hard to measure it, so I'm happy to have a discussion. There aren't actually a lot of other measures out there. So there isn't really any survey data that goes back over time. Betting markets typically don't measure this stuff. It's actually quite hard to think. The other source of information on, insurance companies actually have, I don't know, SCOR has their own indices, but there's a publication that sometimes insurance companies put up, but that tends to be more like earthquake risk, and it's quite hard to get these general uncertainty measures. The other thing that people have primarily used is financial market measures. So this is the VIX. It's the 1 month implied volatility in the S&P 500, the US stock, effectively the US stock market. So it basically, the implied vol means how volatile you think it's going to be over the next month. So if you think the market's going to bounce up and down a lot, this number's high. If you think the market's going to be stable, this number's low. you notice that since I got this from Fred, it automatically puts these grey bars in. Uncertainty tends to rise in recessions. It also tends to rise around financial crashes. So,
excuse me, how is it measured? It's from option values?
Yeah, thank you for asking. You should ask questions. Definitely from seminars. You get very nervous, you know. If you teach MBAs, no one asks a question for like 10 seconds, it's a problem. How's it made? So there's a bunch of put and call options on the S&P 500, and they want to have a moving window 1 month out. So there's not always an option that's exactly at the money 1 month out. So they kind of take there's some complicated maths about their smoothing between puts and calls either sides, and 25 days and 35 days and 40 days. There's actually what's called an entire vol curve. So you can get implied vol on the S&P up to 10 years out. It's not publicly traded. I've got the data from Goldman's. Interesting enough, the 1 month moves around a lot. The 10-year doesn't. I mean, it's kind of like the interest rate curve. The 10-year doesn't move as much, actually. But so this is like 1 month implied vol. This, by the way, looks a heck of a lot like realized vol. So volatility in stock markets tend to be persistent. So it's been really volatile for the last couple of days. The stock, I don't know how much people are tracking it this closely, but yesterday and the day before, the S&P fell by 1% 2 days in a row, which was a relatively big drop. So the VIX is somewhat higher today. Yeah, Francis.
Do you measure, do you monitor flows in your websites, in particular the one by the IMF? Because in principle, even if you are getting the uncertainty correctly, the fact that you measure it, and this measure is publicly provided, could have an effect. If the IMF produces a new measure of uncertainty, that actually has an effect, at least in the reducing uncertainty about uncertainty itself.
No, I've back in the day when I published the paper in 2006, I present the original Baker, Bloom and Davis paper in 2013. People would ask, "Oh, how's your paper?" I was like, "No." I mean, the media coverage of that paper is like zero. I mean, the media doesn't pay much attention to this stuff. I have to say, there is some grain of truth now in what you say. I start to be a little bit worried because the data, particularly this data set. So we put all the data up online. Whereas this data set, and like Bloomberg carries the data. I mean, one of the things, just my experience as an academic, Raj Chetty is the expert at doing this, but if you have data and put it online, it's like really it's like a great idea to do it, just in terms of citations. But we put all our data online. And it's also got picked up by like Bloomberg and Reuters and Haver. And I know there's lots of like central banks and people like that using the data. So I think you're right that implicitly, because this graph is going up, people kind of cast around for something to blame, and they partly blame uncertainty. So it's a bit like the flavor of the month. So, there is some feedback, there is some echo chamber. It's very hard for us to assess that. That's partly why we went to the Economist Intelligence Unit. The Economist Intelligence Unit, these reports are aimed at like Procter & Gamble or private equity funds that are thinking of making big investments in like Gambia, want to know what's going on. So they tend to be less influenced, and they're not typically people reading FOMC minutes. But even there, you could worry about it. It is a genuine question of how to measure. If we've got time at the end, I can come back. I'm actually setting up a survey with the Atlanta Fed where we're surveying thousands of companies. But the problem is we've got no historical data. So we got that survey up and running. It's been great, but it's hard to go back. Sorry, am I standing in the wrong place?
No.
Sorry, sir.
So this is based on newspaper coverage of current events. So in principle, investors should be able to read Boston Globe or Wall Street Journal on themselves, so they don't need to go to your website.
Yeah.
Well, you're doing a useful service aggregating it, but other than that, probably it's just a reflection. It's not original news that you report.
Yeah, you're right. So. I'm sure that hedge funds are like massively sophisticated, and there's some of the things that I'll show you later. I'm sure a lot of hedge funds have done already. They just don't release it. I remember talking to a friend of mine who runs a hedge fund in the Bay Area that this was like 5 years ago, that said they bought the entire Twitter feed and were scraping it. I mean, it was like really subtle things. For example, the first time people were really into the Twitter feed is there was an earthquake. I mean, it wasn't a big deal beyond this fact that there was an earthquake in Washington about 5-6 years ago. I don't know if anyone remembers, but as in Washington, D.C. in the US, and it was first picked up on Twitter because so many people were tweeting about earthquake before the government put up. I think the upside of what we're doing is it's easy for academics to do it. And I know one of my friends at Lehman Brothers uses this. A former friend from London just said, oh, it's easy because I can just download it from Bloomberg, so I don't have to bother to create it myself. So it's like a ready package index, but I agree they could have done this anyway. So the question I wanted to pose in part is related to this. So has uncertainty truly gone up? Well, the other measures of uncertainty I like to use is stock market volatility, and this isn't particularly high. So stock market volatility right now is at very average levels. So that seems kind of odd. And I'd say it's a puzzle, and if you read the Wall Street Journal or like pieces that Goldman Sachs put up, I've spoken to people at Goldman's a few times about this, there's a general puzzle in the markets. Why are stock markets so unvolatile? So, for context, stock markets for the last 3 or 4 years have actually been pretty calm, much calmer than they've been historically. So this project was trying to look at the stock market and to try and understand volatility. We decided to look at stock market jumps. There's a long, colorful history of stock markets. So this wasn't really the stock market, but some early jumps and crashes. There's things like the Dutch tulip mania of 1637. So this tulip was called the Viceroy tulip, and apparently the height of tulip mania, it was valued at 20 years of a worker's wages. So a typical worker's wages now is it's like $20,000 a year. So that's $500,000 for a tulip bulb. Seems like implausibly much. And of course, a year later it wasn't worth anything like that. Then there's the South Sea bubble, which is kind of more of a financial market crash. The South Sea Trading Company was set up in principally to have a monopoly on trading rights in the South Seas, which is like the Pacific, but it was actually a vehicle to trade government debt, and there was a vast scandal and thing collapsed. So we're going to go slightly more recently in time. We're going to look at stock market jumps from 1900 onwards and try and figure out what causes these as an insight into volatility. So we're going to define a jump as when the stock market changes by more than 2.5%. Why do we use that threshold? That threshold turns out to work quite well. It's on average 3 days a year are defined as a jump. So in 2019, there have been 4 jumps. You may even personally remember them. There's one at the beginning of the year, and then there are 3 in August, which are related to trade. You're
comparing the closing price for the end of the day, so it's daily?
Exactly right. So they could go up and down by more than 2.5% in a day and close back down again. We're just going to look day-to-day close. Okay. And we're going to look at the next day's newspaper. So why the next day's newspaper? The nice thing about 2.5% jumps is they're so big, they're always reported in the next day's newspaper. So since World War II, every 2.5% jump has been reported in at least the Wall Street Journal and typically the other papers. Well, right now, I'll come back at the end, moving down the threshold. If you look at 0.5% jumps, it's not clear it's there. The reason that matters is if there's a jump because of some boring Fed announcement that's like 1%, the newspapers may not cover it. If there's a jump because Trump says something, rude about the Fed, and it causes a 1% jump, you can bet the newspapers will cover it. So we want to go with 2.5%, so there's no selection on what causes it. Every jump is covered. They always have an article. The articles always explain the jump and try and account for what occurs. And these are the 4 for this year. So why does the market move? So just in terms of theory, there's kind of 2 extreme views. One of the earlier times, the weird thing is I was presenting this in Chicago. I didn't realize Eugene Fama was in the audience. I had no idea. There was like his picture up there. He was sitting, it was slightly spooky to be like going through. But he didn't say anything. He asked some questions later on, but he didn't. So there's like at one extreme, there's Eugene Fama type of view, which is all market moves are rational. And they're driven by 2 things, either views of future dividends or views of future discount rates. And if you don't understand them and the market jump seems to be irrational, it's in Fama's world, it's because you're the fool. In a sense, something's gone on, you're not understanding it. So maybe some complicated covariance with some risk structure that you've missed, but the market gets it. So the Fama style of the world is it's all rational. If you don't understand it, you've made the mistake. Somebody out there understands it. And then at the other extreme is Schiller that would say, look, some of the jumps have clear reasons, and we'll come on to some that obviously have clear explanations, but there's at least some of these are explained by what he would call narratives. They're kind of scare stories, bubbles, things that really aren't connected to reality. And that's often the general public seems to have this view of the stock market. It's a big casino and people are widely, it's always these photos of guys in colored brightly colored jackets waving pieces of paper around, and the market just seems to randomly go up or down. So this project's going to look at stock market jumps. This definitely isn't the first time to do it. What we're going to do is just be more rigorous in terms of size and scale, but I'll just go through what's happened a bit before. So there's some earlier work that's had humans read the next day's newspaper. So one of the earliest pieces was by Victor Niederhofer, and he looked at newspapers, and he looked at major news events defined by the size of the type font at the front page of the New York Times. So the biggest type font ever was Titanic sinks. That's apparently the largest words ever on the front of the New York Times, at least at the time he wrote his piece. And he shows that he analyzed 432 major news events and shows when there are major news events, there's significantly more likely to be sort of major changes in stock market. So he's going, if I was going to do a diagram, he's going from news to stock market. And he's saying when there's effectively a news jump, you're more likely to see a stock market jump. Victor Niederhofer himself is like a total character. If you go to his, you should look at his Wikipedia website, not now, but I think he wrote his own Wikipedia website. It's like hugely amusing that, I was almost going to screenshot it. He's like the master and champion of so many things. And like, it's just so much like, I mean, he seems to have achieved a lot, but I don't know. It's like he's very wealthy. He's much richer than me, that's for sure. And he's the world. You just read his Wikipedia website. It's quite entertaining. And then there's Cutler, Potoba, and Summers that did the reverse. They went basically from stock market jumps to news. And this is a very famous set of co-authors. Jim Potoba now runs the MBR, Larry Summers, and David Cutler. They wrote that in 1988. That's probably a giveaway for what they were driven by. In 1987 was the Black Monday, the biggest stock market crash ever. So the stock market dropped by 20%. That is an amazing event. It's still an amazing event. The second biggest drop ever of the stock market is 12%. So that 1987 Black Monday is a total outlier. It's like enormous, and there's nothing come close to it, actually. So they wrote that paper the year after, because there's a flurry of papers in that era, like why do stock markets jump? Because 1987 still really has no proper explanation. So if you read the newspapers, it's covered as one of our jumps. Different newspapers give a whole laundry list of explanations. It's not clear. But they came up with a slightly more depressing view, which is actually going to turn out to be kind of consistent with us, which is if you go from stock market jumps back to news, you can't explain a bunch of them. So they read that as a negative, saying there are many stock market jumps that have no news behind them. You could flip it around, and about half of the jumps do have news, half of them don't. And this has been extended by various people, but I'd say that's kind of where the literature is. There's also more recent literature using computers. And the computer literature, you can imagine what it does. It's a vast text. It takes every bit of the Wall Street Journal, or, for example, Tetlock's piece, one of the earliest pieces, there's something called Abreast of the Market in the Wall Street Journal. So Abreast of the Market talks about the stock market yesterday. It's a daily comment. It ran up until the mid-2000s. He takes Abreast of the Market and then does a search using the share of negative words minus the share of positive words and uses it to predict the stock market. It's not, in a sense, very sophisticated, but you should know that's 12 years ago. So there's a vast industry of people now doing computers to scrape the stock market. So we're going to do something that seems a bit old school. We're going to use humans. We're going to code every jump of more than 2.5% in the next day's newspaper. We're going to do it from 1900 onwards. Why do we do that? Well, that's already 1,200 jumps. That's a lot. We're going to have multiple people coding each jump. So there's just a lot of person power to do this. But it accounts for 47% of total daily volatility. So if you're interested in stock market volatility, you actually get half of it just looking at jumps. So looking at jumps is pretty informative. It's very practical. Newspapers always discuss it in the next day. There's no selection bias. And I'm going to show you evidence for 15 countries. I'm going to focus mainly on the US because whereas our data is best, but we do have data for other countries. Yeah.
I don't know exactly the institutional framework, but I know that now there are cuts in the market. Basically, if there is a too strong a decrease, for instance.
Yeah.
So I assume that it should wipe out a lot of the volatility as measured by jumps, because you will have smaller jumps now. No?
There are some markets that have these, like, they close the market, you're right. I don't believe that happens in the US. I don't know if anyone knows. I've heard it happening in typically in like less liquid markets.
9/11, didn't they close the market?
They did not open for a couple of days.
The New York Stock Exchange. Yeah, what do we do then? That's true. It's a good question. So we can't include, I mean, you're right, we could, let's make an, but, here we go. Yeah, we definitely have no date. Market closed. Well, for 9/11, if we really wanted...
The closing was on dungeons.
Yes. I mean, for 9/11, if we really wanted, you could go to London, because I've got VIX data. So it turns out there's something called, or there's a European, I can't remember what it's called, VEuroX or something that basically tracks the VIX pretty closely. But I don't know about let me think about it. I think normally when I've seen these rules that stop trading, they're more, I don't even know if the US does it on individual shares. There are countries that do it for individual equities, like for General Electric. I haven't seen the whole market closed. But it may happen. I'm going to show you a sample of 15 countries. I'm not quite, we should have a look at it. I think for us, the closures typically are at jumps that are bigger than ours. So we're going to look at 2.5% or more. So it might have been 7, but they closed it at 5. We're still going to see the jump. It's a good question. I should look at the close. We will miss the data on 9/11. I don't know how we deal with that. It's a good question. I'm not sure what we've done about it. Yeah, sure.
What happens if you have several days with 2.5 or more jumps that repeat themselves over several days, and then you have a correction, and then so you have many events like that where you have successive jumps.
Right.
So the continuation of a jump is not like the start of a jump.
So there's some interesting kind of points here. Is that we decided to go for the next day's newspaper. So often people ask, why that? Why not like The Economist magazine? So The Economist magazine or longer run outlets only tend to write about really big jumps. So if you actually want 2.5% or above, you don't have much else actually, as it turns out, except for the next day's newspapers that's publicly available. So we're always going to look at the next day's newspapers. If there's days of consecutive jumps, I don't think there are many, but there will be more than would be implied by random variation because vol itself is persistent. Then we would just read each newspaper the next day. So, for example, if Trump says something really negative in China and the stock market drops, and the next day says something even more negative and it drops further, we'd read the articles. And assuming the articles are written properly, we would interpret them as, because they're normally talking about that last day's jump. It's true there could be some confusion, and particularly when you go back to like pre-war, particularly the Great Depression, some of those things are not perfect. So some of the stuff I'm going to do post-war, basically newspapers are pretty good post-World War II. If you go back to like, I'll show you a few articles from like the 20s, and it's partly the text quality is problematic. Someone's taken a photo of them in like the basement of a library, and you can see like some of them have coffee stains and things on them. But then also just the standard of journalism is, I mean, notably worse actually. So whatever reason, we're going to take the newspaper after the market closes. And the reason that's also relevant now, because there's another problem we're facing now, is that often the article is written before the market closes, and then it's updated. So there was a jump that happened in August that the Wall Street Journal, the jump put it out before the market had closed, and then updated it after the close of the market. We always use the kind of end of day piece. They often know what's coming, because stock market's a random walk. If it's risen 4.5%, it's pretty likely, and it's an hour before closing. It's extremely unlikely it's anything else, but that's going to happen. I mean, in some sense, it is what it is. About a year ago, I was presenting some journalists, oddly enough. There was a board in Stanford, some kind of board of trustees, including some journalists, and the journalist said, "Why don't you find the truth? Like, why don't you compare it to the truth?" I'm like, well, there isn't. The newspapers are actually, oddly enough, I mean, I understand a bit more about historians. You want to go back and discover what happened. They often don't have, I mean, the newspaper is probably the best primary source we have for many of these things. So we're very reliant on newspapers, but I'm not sure for most of these jumps, there's probably not much else out there.
So you mentioned that on average there are 6 jumps per year, but I can imagine that, the distribution is quite, the threshold 2.5% could be meaningful today, but could be just much more common in a period of distress, or in a more developed, in a less developed country, like I would expect it.
You're exactly right. So within the US, so there were about 3 jumps a year post-World War II and about 12 from 1900 to 1945. So it turns out that there are periods in 32 and 33 that they don't have. 2.5% is nothing in 32 and 33. The market's like bouncing up and down like every day, and they just get bored of writing, you know, stock market crashed for a 5th day in a row. So they just don't write the article. In other countries, we pick that threshold, so it accounts for about 2% of trading days. So I'll show you the slide. I think we have the threshold. Like in, we have one for New Zealand, and the threshold's probably 3% because their stock market's more volatile. We basically want to aim post-World War II to be looking at something like 3 trading days a year because you want them big enough that the next day's newspapers can report them. So I agree. 2017 had no jumps. I don't know if people are aware. 2017 was VIX reached its all-time lowest level in spring 2017. The stock markets were really quiet, which is odd because Trump had come in, but nothing seemed to happen. So why use human coders? We've had various, human coders, there's these photos, everyone's smiling, that's because it's the photo. But it highlights pretty obviously to anyone that's tried to manage teams like this of this size on an ongoing basis, it's painful. I mean, that's Scott Baker. Well, there's Scott Baker there, and he's a grad student. One of my co-authors, there's Marco Salmon, another one of my co-authors. This is a picture, a painting in Stanford. We tried to make it look like this person was part of the team. It's great working with undergrads and grad students on this. It's primarily undergrads, but it's very costly. It's just costly resource-wise, and it takes a lot of time. We basically do it in waves each summer because there's big fixed costs and have someone that runs along. So why use human coders? We've tried using computer analytics to do this, so taking the articles or natural language processing, but there's some major challenges. One is economics knowledge. So we want to try and distinguish between a stock market jump that is, imagine it says the stock market rose by 3% because the Fed cut interest rates. There's 2 reasons why that may have happened. One is they're basically following the Taylor rule, and there's some fantastically positive news that's come out. That's basically macro. So there's some news that causes the Fed to cut interest rates. Another story is, who is it now? Jay Powell says, President Trump's persuaded me interest rates should be much lower going forward. So that's basically a monetary shock. So reading between them is very hard for a computer to do. A second thing is language changes a lot. So for example, the word commerce was used in the 30s. Now it's really economics. The word war, we've done some natural language processing. The word war you'd think would trigger military imposed jumps. It isn't. It basically is trade because it's trade war. And then one of the other categories is drug war. I mean, it's really not it's actually much more harder than you think. And then in some ways, the hardest is context. So there's a jump that happened in 1940 that was blamed on that German man, which, we all know who that is. It's Hitler. Turns out if your computer, well, that's pretty hard to figure out. And to make it worse, Hitler was actually Austrian. So, if you went to Wikipedia, imagine you coded it up. Who knows what, so these things are pretty hard on Martin. So the jump is blamed on Martin. I don't know who people may think it is, but it's possibly this guy, William Chesney Martin. He was the longest running head of the Fed, but that would be only relevant when he was the head of the Fed. Or even worse is Ford. I mean, Ford is a nightmare. There was President Ford, there was Ford Motor Company, there's Harrison Ford. I mean, there's lots and lots of Fords. Harrison Ford probably doesn't cause stock market jumps, but I mean, you never quite know. Gerald Ford, yeah.
He was vice president of Nixon.
And then president himself.
Then president.
Yeah.
Then president.
I mean, I put this you can see the disambiguation. So, what are the key what are the key findings? So, policy turns out to be really important. About 40% of US jumps are attributed to policy, slightly less international. But I was really struck by this. I thought that stock market fluctuations would be mainly reflective of company news or macro news, or turns out government, particularly the US government, is a huge driver of stock market volatility. Maybe it doesn't seem so surprising recently with Trump and the Fed, but it's historically still been a huge driver. Secondly, the US dominates globally. So there's this long literature about somehow the oversized importance of America internationally for financial.
Could you just tell us how your coders, what categories did they?
Oh, I'll tell you in a minute.
Okay.
I'll come back. Yeah, I'm just going to give you the.
All right.
So the second is the US is. So we have lots of different countries. So take a country like New Zealand or Saudi Arabia or South Africa. We code. It turns out that US is like 4 or 5 times as important for explaining South African markets as, say, the whole European Union is. But the EU has similar GDP per capita. So for reasons, you can come up with a hypothesis, but much like the dollar seems outsizedly important, US stock markets seem to have a massively important, outsized impact globally. Types of jumps matter a lot for what comes next. So if a jump is driven by monetary factors, volatility falls pretty rapidly. It seems like the Fed calms the market. If a jump is driven by macro factors, say GDP figures or inflation figures, volatility stays high for a while. And then finally, the other thing we focused on is clarity. So coming back to the Fama-Schiller thing, there are a bunch of jumps that are really obvious, and there are a bunch that it's very hard to tell what's driving them. And I'll come in detail how we actually define clarity. But volatility remains much higher after unclear jumps. So occurrences where the stock market jumps and no one really knows why. And it appears like the market's taking many days to try and figure this out. So why don't I go through the approach, then what we find?
Sorry.
Sure.
It's very rare that newspapers do not interpret a movement, right? Even if they don't know why, their readers would not like to hear, well, something happened, but we don't know. So there's a bit of ex post trying to find out the real explanation, and so we don't know if that was the cause or not, actually.
You're exactly right. So why don't I explain how the process goes? So I've interviewed quite a few journalists to ask them how exactly they do this. So here's the world of the journalist writing this. So one thing they have is the tick level data. So they don't just write at the end of the day, they're seeing the market move throughout the day. So there are a bunch of events where it's like immediately obvious because the market, Janet Yellen, and that makes an announcement at 2:15 p.m. Eastern time that interest rates can be cut by 0.5%, the market just bang, jumps up. They see that on their screens, and there's really no need for them to phone anyone up. They may still phone people up to get quotes. Their normal process is they look at the tick level stuff, and they start to phone people up towards the end of the day. They have a series of contacts they said they'd ring up. If the first 3 or 4 give them the same story, they'll go write their piece. If they don't, they'll keep ringing, but at some point they need to write their piece and send it to the editor. They said the thing they hate most of all is to be wrong, but they also hate to say don't know, particularly if the Wall Street Journal says don't know. In fact, I'm going to show you an example in a minute where the Wall Street Journal says don't know, and the New York Times and the LA Times both give examples. They don't like that. Actually, I think in that case the Wall Street Journal is correct, and the New York Times and the LA Times is basically making stuff up. But I'll show you. We can decide. I actually was working on this stuff this morning. So I'll show you in a minute. About 11 or 12% of jumps they just say are unknown. So in reality, it may be higher. They have a natural bias basically against saying don't know. But if they really don't know, what they don't want to do is say it was Iran saber rattling on oil, and then it turns out something completely different and then made to look an idiot. And there's also flavors. So the other thing is I'll show you in some articles, there's flavors of don't know. So if you speak to journalists, they have this pyramid structure of articles. They get the most important things they know most at the top, and then they go down. So generally, after stock market jumps, in the first 2 sentences, the 2 facts they're trying to write down, if they know them, is what the size of the jump was and what caused it. And if they don't know what caused it, generally they'll wait. So they'll spend more time saying what the jump was, then talk about sectors. So if they don't know what's going on, a typical story starts, stock market fell yesterday by 3%, banks and high tech fell the most, industrials and manufacturing fell less, markets were soft in the morning and then started falling in the afternoon. Basically, they're not telling you what caused it because they don't know it, and they'll tuck it further down in the article. Whereas if they're certain, they'll say stock market fell yesterday after Janet Yellen rose interest rates. So I'll come back to show you. This is why another reason the big difference with humans can figure this out. So the bit of training, if you know how articles are written, how journalists work, you can pretty fast read an article to figure out how confident they are. So we have a thing called the clarity measure, which is a kind of weighted average, principal component of various other things, including how confident the journalist is, which implicitly is where they put the answer. But you're right, they try and avoid saying don't know, but in 12% they flat out say we just don't know, which is surprising. I'll show you one of them in a minute, actually. So I think we've been through this. 2.5% threshold, go to the next day. We have multiple coders, which is individuals. They're going to try and read multiple articles. So people are randomly allocated to different newspapers. So in the US, we have Wall Street Journal, LA Times, Boston Globe, Chicago Tribune, and New York Times. The key things we're after is the reason for the jump, the geographic source, the confidence of the reporter, like how much they assert it and how clearly, and finally ease of coding. So typically, if you can easily code it up, it's a clear article. If they're waffling around and they're really not certain, it's harder to code the thing up. So the summit's really unclear as to what caused it, and basically it's, but these two are kind of related. They're not the same, they're pretty related. So, as you asked about the categories, from a lot of iteration going back and forwards, here are the categories we ended up with. There are a bunch of policy categories, spending, taxes, monetary policy, exchange rate, trade, sovereign military, which is invasions both domestic and abroad. Like Saddam Hussein's invasion would be sovereign military. It's done by a foreign government, but it's still a foreign sovereign. And then non-policy categories, which would be terrorist attacks, macro news, corporate earnings, etc. So my assumption out of interest was these two would dominate. I thought macro news and corporate earnings, that's going to be it. I mean, what else is there? Maybe a bit of oil price shocks and wars, but they don't happen that often. Given there are 3 jumps a year on average, there just aren't enough of them. Turns out, yes, these are the 2 biggest categories, but they're collectively still only about a third.
So where's the election?
Oh, sorry, elections.
Okay.
Elections, political transitions, yeah. This turns out to matter less because in order for this to trigger, one of the things that, is stock markets only respond to news. So it has to be that a lot of information is released. So I'm trying to think where these happen. If there's a surprise against the polls, and it matters. So the parties are really far apart. Like, if Corbyn unexpectedly won, the British stock market would plummet. But otherwise, if Boris Johnson wins as predicted, it would just sail flat through. By the way, Trump, there's a really interesting thing. Steve Davis is looking at, if you look at the Trump election, as everyone knows, Trump overnight, before the markets closed, it was down 4% and then closed the next day up 5%. So the within 24-hour swing for Trump was about 8%, which is enormous. So initially, the markets were really negative on Trump. And then by the time the stock markets opened, it was flat. And throughout the US trading day, it rose a lot. And it was driven by regulated sectors. So sectors that are regulated, for whatever reason, people suddenly realized, wait, Trump is going to be light in regulation. So a lot of banks did really well under Trump after the election.
Will we classify elections into close elections? And
we haven't looked at it. We just said we're just going to base it on elections. So
don't care about the sign.
We haven't. I'm going to do analysis. We know the sign. We know the change. When we code it up, we're not going to care about the sign. But I'll show you there are positive and negative for most of these. Some of them tend to be. There is
the same news can, recovery can sometimes
most of these probably
create a slump in the stock market. Right?
I think most of these will have both positive and negatives.
Right.
I think so. Having looked at them, it's not totally balanced. It's not. I'll come back to that. For example, there are more positive than negative policy, and the reason is certainly in the last 30 years in the US, policies significantly more positive because they announce in a big fanfare good news and they leak out and try and bury bad news. So the bad news gets out there, just spray it out over 4 or 5 days, so it never creates a jump. So it's not, I don't want to say it doesn't matter, it just doesn't. Let's come back to our trigger matters for them.
So the point is that somehow you are measuring what cannot be forecast in advance by the market.
Yes.
Because, for instance, in the case of the sovereign crisis in Italy, when a rating agency gives us a very low rating, usually the market does not react because it has been reacting before.
Agree.
So it adjusted well in advance.
So this is why, in some sense, it's linked to uncertainty. It's stuff
exactly.
Stuff that's known and well predicted and well signed.
You cannot predict
and it also, you need enough revelation at high frequency. So, like the fall of the Berlin Wall, this doesn't show up anywhere because the Berlin Wall was a surprise it would fail, but it fell over the course of 2 years. It became apparent it was going to happen.
You don't have climate events, storms,
natural disasters.
It could be under other non-policy. It's a good question whether there are any climate events. I don't know if there are any that show up. I mean, it's possible Katrina. I don't know the day that Katrina. It partly depends. If Katrina had happened, suddenly hit New Orleans unexpectedly at like 4 p.m., so the market was closed or something like that, Katrina was clearly a big deal, whether it would have dropped the stock.
It's very important for SCOR.
No, that is what they have observed because it's something we have.
It may well happen
in the past, even in Japan, for example, between the two.
Oh, well, so in Japan it was. So Japan, because remember that's why Nick Leeson, that's the collapse of Barings Bank, was because what's the name of that earthquake? No, it wasn't Fukushima, it was the Kobe earthquake. Do you remember Nick Leeson, the story of Barings Bank, that Nick Leeson made all these bets and he was like double or nothing and he kept losing and he thought, this was like 92, I'll finally clear all the money by making one enormous bet on the Japanese stock market. So he made this huge bet that the Japanese stock market would rise, and overnight was the Kobe earthquake and it dropped 8%. And it totally wiped him and the entire bank out. So he was kind of unlucky, but he shouldn't, they should have had risk controls to have stopped him doing that. But so we also have a very detailed painful coding guide. There's millions of FAQs and multiple examples, but why don't I go through some of these just to give you an idea of what it looks like. So here's example one. This was from last year. Some of these jumps are quite recent, you may even remember them. The S&P index dropped by 3.75%. That was a really large drop. It's hard to anticipate. There was nothing, I think, 3.75% is a really big drop. Dow Industrials plunged into correction. You notice it's pretty upfront. Fears that a pickup in growth and inflation could cause central banks to tighten monetary policy. I don't know how a computer would code this up, but we code it up as macro news. It's basically growth, it's inflation. So this is really growth and inflation.
You tell us that the macro news generated a jump in the stock market of a given absolute value, right?
That's how we would code this. So
we don't care that, maybe next time there is a pickup in growth and inflation, the stock market could go up instead of down, right? There's no consistency in the explanations given by the news.
Well, normally, so here it's inflation, I presume, primarily.
Yeah, sometimes it's inflation,
growth,
sometimes it's growth.
Growth normally is priced positively. I'd assume inflation is priced negative. I assume what's going on is inflation is hard.
Because they come together, there is always an explanation for the move in the stock market. If it goes up, it's growth. If it goes down, it's inflation. You cannot be wrong because they come together.
To some extent, you're right. So coming back slightly, linked to Francisco's point, we're going to focus on, I want to focus primarily on uncertainty. So you're right that
exactly.
I'm going to call this macro.
Correlations between absolute values and the size.
Macro news is pretty balanced. There's positive. So this is macro news, and the geographic source would be the US. So this is a reasonably straightforward one. This is another straightforward. This is an enormous drop, 8.7%. Probably most of you remember that. That was when the TARP 1 was turned down. It was a huge event. I remember that in person. I think I was listening on the radio in the car. The House of Representatives defeated the White House. Right then, it was historic $700 billion financial rescue plan. Of course, it got through eventually with a revision, a stunning turn of events that sent the stock market into a tailspin and added to concerns the US faces a prolonged recession. So again, straightforward. This would be coded as government spending, and geographic source would be the US. So again, it's pretty clear. Here was 2007. This is quite rare for the US, but this is foreign stock market. So second line, the catalyst was Tuesday's nearly 9% fall in stock prices in Shanghai, one of the hottest and most volatile markets in the world. So the article, basically, it just blames it entirely on Shanghai. It doesn't do anything. We don't know what drove Shanghai. In theory, we could go and look in the Chinese stock market. We have done that, haven't connected up. For the US, this is rare. If you go to New Zealand, like a third of the articles are like this. They just blame the S&P 500 and don't really go any further. So that would be foreign stock market, and the geographic source would be China. Here is just an older article. Financial markets soared in reaction to statement over the weekend by the Federal Reserve Board chairman that the central bank would pay less attention to weekly swings in the money supply. So this is monetary policy. It's not kind of modern Taylor rule monetary policy. It's when they used to target the money supply back in the 80s. But again, it's just a clear indication of money supply, and again, it's US. So here's 5. What would you code this? So I've took the code. I'm going to wait to everyone to slowly read this, and we can have a discussion. How would you code this one?